It's not more than a couple of years. It's probably not less than 6 months. So the question is, like, do you want to? I think you should be doing it now. The worst financial decision I ever made in my life was probably just leaving Blackstone in 2005 to go do something else. I think there's a lot going on. There's so many answers to that question. And I think they're all right and none of them are right. I'll try to take a stab at the biggest misses that I think the market is getting. Anyhow, the lift breaks down. Brandon and I are stuck in the lift. And in those couple of hours, we kind of were just talking about life. And I said, well, why don't we maybe think about doing something together? And then that was the genesis of that. That's kind of how it started, stuck in a lift working on Richard Croft's project. There's at least a recognition that it's not just black and white. There is nuance to it, and some offices you do want to buy and some you don't want to touch.
Michael, welcome to the podcast.
Thanks very much for having me.
Not at all. Well, look, we'll come on to Castleforge later in terms of our conversation. But a place that I always like to start these conversations is how and why did you get into real estate?
Oh gosh, starting to be a long time ago now. I studied a number of real estate courses at university. Kind of just fell into them as elective courses, and really started to like them, and had some great professors. And so I suppose you could say that I caught the bug then, but it wasn't until a little bit later in my career that I actually got into real estate. I was in investment banking initially in New York back 2005, so almost 20 years ago now. And it was just general M&A. It was little known shop that you may have heard of called Blackstone. I always like to say that the worst financial decision I ever made in my life was probably just leaving Blackstone in 2005 to go do something else. So there you go. You can thank real estate for that. Anyhow, I left Blackstone. I was in the M&A group there. And then I came over here to London in 2005 to work for a company called Westbrook, who was building its office up in Europe. And they needed a guy to carry people's bags. And then that was me.
So before we get on to that,
yeah.
You're from the US. Where in the US? And did you have any friends or family that were in the real estate game that kind of maybe influenced you at an early stage or not?
Absolutely not. So I grew up in Fort Lauderdale, which is a city or town outside of Miami over in Florida. And family was not in the real estate business at all. And so there was really nothing that influenced me there. It was purely once I got to university. I mean, I always thought real estate was interesting, right? I mean, buildings are kind of cool. You look at them, you see them, touch them, it's investing, but then it's sort of a concrete element of investing. So it was always something that was of interest, but I wouldn't say that there was anything in particular that spurred that interest other than, then I get to university. So I was up in Philadelphia. And one of the professors was, he used to work at Trammell Crow. So, I mean, you had people in the industry. There was a very famous guy, Peter Linneman as well, who kind of had this letter that he would write to investors. And so there was an overlap between just being professorial and educational, but then also a lot of people in the program were very much hands-on, very much industry experts. And they had such a wide range of classes that you could take, ranging from like entrepreneurship to development to all these sorts of things. And I was like, man, this is really cool. And the people as well, the classmates and everything, they all sort of were very similarly inclined, I think. And it was a great group.
So the idea was to kind of go and study a kind of a broad business, economics, commerce kind of degree.
Yep.
And then work out which route you wanted to go forward? Or was it kind of always banking was the kind of the path at that stage?
Oh, certainly not banking. Again, I don't have banking parent. I mean, my father's a GP down in Florida. So as far away from banking and finance and real estate as you can probably get. And so I really just kind of fell into that. I mean, I remember I think we were doing summer internships that, you do in banking now. In your penultimate year. Now I think it's even earlier, but it was I think junior year or something like that. And everybody was talking about iBanking and iBanking and iBanking. I literally thought that they meant internet banking. I have no idea what iBanking is, investment banking. I was a complete neophyte in terms of the financial industry. So it was, I mean, and I was at Penn, I was at Wharton, and so it's hard not to get sucked into the whole banking and finance thing. So all my friends were doing it, so I was like, okay, I guess I'll try this thing out. And then ended up getting an internship at Blackstone, where I spent a very great summer, 2004, and said, I don't really know what I want to do in life. Let me go into the M&A group where there's this like wide range of things that people are working on. I'll figure out what I want to do later, but I always have in the back of my mind like, oh yeah, real estate, that's very cool. And then that was kind of my foray into finance in New York.
So you did a couple of years in the M&A team, and then the opportunity to join Westbrook Partners over here in London came up as they were looking to expand their wider team. Why did you decide to leave the US and come to the UK?
My father's actually from Hungary, and he came to the US in the 70s. And I said to myself, well, I really haven't spent a lot of time with my other side of my family, who all live in Hungary and still do. And so that was a great opportunity for me to kind of reconnect with that side of my family. I didn't study abroad at university. It was very much like go, try to, study and do as best you can and everything like that on the academic side. So I felt like I didn't really get an opportunity to maybe explore, and you don't do gap years in the US really to the extent that they do here. And so I thought, wow, this is a great opportunity to do what I kind of want to do, to get into a sector I want to get into, an opportunity for me to reconnect with a large part of my family, an opportunity for me to go somewhere different. And then the plan was always, okay, and then in 2 years, I'll come back to the US.
Classic.
Yeah, classic. 20 years later. Still waiting.
So Westbrook, you joined Westbrook in 2006 as an analyst and associate, or?
Yeah, the guy who runs the shop here, Mark Donner, maybe you've known him or come across him. I like to describe it as like not Mark, right? I mean, it was Mark and then everybody else, or there was a guy Sush at the time, who's got his own fund now. So the two of them were kind of the principals of the firm, and there were a couple of other guys, and I was just the guy that was hired to do everything else at the junior level that nobody really wanted to do. So I think they called me an associate, but I didn't know what that meant.
But you were working across transactions, portfolio management.
Yeah, that's right. So the thing about Westbrook that was so unique, and why I think it was a great experience, and probably allowed me to do what I did in a very short period of time, setting up Castleforge, was you were sort of expected to be everything. It was a very small team. I mean, I think there were probably 6 people here in the UK, and that was really in Europe. We had like 2 guys in Paris, and so when you bought a building, you'd be analyzing it, you'd be putting the financial analysis together, and then there was no like asset management team to hand it off to. You were the asset management team. And so you would just live with that building from start to finish. And so that meant a lot of looking at all different opportunities, but we were a vertically integrated fund management business, which meant that there was a there was a huge opportunity early on to take a lot of ownership in a lot of these projects. And that meant going and helping to design the building, and then helping to make sure that everything's going well during construction, and then go out there and lease the building, and then ultimately go and sell it. And so, yeah, from a very, very early time, I had the opportunity to do all of that and see all of that. And it was great too, because who ultimately became the COO of the business, he led the charge. I think he parachuted here into the UK maybe 3 months before me. And I was, like I said, I was his bag carrier, right? And so I had a great 2-year, 3-year experience before he headed back to the US, where like everything that he was fixing or growing in the business, I was the guy to just okay,
implement it.
Right. Well, yeah, exactly. I'd like to think implement, but at least get involved with it.
And or have eyes on,
exactly.
what he was
eyes
thinking
on
and like how you'd fix things.
Totally.
So you saw like full life cycle.
Totally.
Of not just kind of real estate investing, but also where does the capital fit in? How do you actually create a business out of this as well?
And he was Westbrook's kind of Mr. Fix-It globally too. So, he would travel to Japan if there needed to be somebody to sort something out. He'd be over on the continent, and I kind of got dragged into these meetings or situations. I mean, and in fact, Westbrook was going to expand into China and India back in 2008, 7, I think it was 7 or 8, and he was like, well, we don't have anybody there. I need somebody to go out there and really spend time analyzing the situation, getting a lay of the land. So do you want to just go out there and do that? And so I was probably spending a third of my time, in terms of like days per year. So I was in China and India probably for 2, 3, 4 months a year between 2007 and 2009. And that was super cool, right? I mean, that was just, I was like, I don't even know anything about real estate to begin with, let alone Chinese real estate. But man, what a time.
And was that partly due to the fact that there were lots of fires over here in the UK and Europe, and it was a diversification play just while the GFC was unraveling?
It was actually pre-GFC. So the plan was, okay, well, there's other markets that you may want to expand into. Whereas then when the GFC happened, Westbrook very intelligently said, you know what, there are so many more opportunities right here in our home markets. Let's refocus on East Coast, West Coast US, and let's focus on London. And so that was very much the end of that. And then I was back in London really full time and continental Europe. So we were really focused on the UK and continental Europe and doing that.
And in terms of the sectors, what sectors were you looking at that time?
Let's see, it ranged. Hotels were something that we were looking at. Offices, industrial. So between 2008 and 2010, yeah, we were pretty early on the multi-let industrial kind of stuff. I know that, I think you've had Richard Croft on the...
I have, yeah.
Yeah, so Richard and I
Twice.
Twice. All right, well, he deserves it twice. I'm only once. Maybe if I get to be as esteemed as he is, I'll come on a second time. But the thing about that was he was probably the only guy really doing multi-let industrial in 2008 and 9, and probably the only one of the few who could really convince international private equity money to go into a sector that I think for a long time people just did not see as institutional. It was a low growth. I mean, put it this way: it's like from the 60s and 70s to 2007. Most of the developed world deindustrialized, right? And so why would you want this thing that was kind of
grubby and gritty and
grubby
granular.
and gritty? Yeah, exactly. And it was every site visit started with like the burger van and everything. So I've seen a lot of burger vans in my time. And so anyhow, that was something that we did. And then offices were something that was really cyclically hit in 2007, 8, 9. I mean, it's different than today, but it's sort of same, but different. But at the time it was, well, I don't even know if JP Morgan is going to be around because Bear Stearns went down and Lehman went down. So, what's a 15-year lease to these guys worth? Like, who knows whether they're going to be there? And so I think, and then rents were falling. And there was too much space, very much cyclically too much space. And then, so it was hard to lease this stuff. And then actually the tenants, I'm not even sure if they're going to be around. So I don't really like this. And you could pick up buildings even after you refurbish them below construction cost. That was a great time.
Post refurb.
Yeah. Post refurb below construction cost in the city of London, freehold. And I was like, that doesn't make sense. By the way, that's where we are today. And actually they're leased now. That's where we are today, 15 years later.
We'll come on to that
later
in our conversation.
I'm sure we will.
So at Westbrook, you're private equity capital allocator, so allocated capital to Richard in the early days in terms of getting M7 off the ground to kind of pursue that multi-let strategy, but also involved in hotels and offices in the UK. And you had a European remit.
That's right.
And a really small, tight entrepreneurial team expected to do a lot of things.
That's right.
Did you feel that in the 4 years you spent at Westbrook, you probably got 14 years worth of experience?
That's what it felt like.
Because of that structure.
Yeah.
And did you ever feel concerned or worried about job security at that stage, just given the wider market? Or not, just because of how stretched and how much stuff was going on and where the opportunity set was at?
It was hard not to, right? I mean, it was, people were losing their job left, right, and center. So you see people around you losing their job, and you're like, gosh, that can be me. And I don't know. I think that but put it this way, there was never a moment during that time where I seriously thought that I was not going to have a job. Everybody was so stretched that, you know, it was like, okay, well, actually the fewer people that there are, the more important I am here. But it did mean everybody was working crazy hours, which wasn't that bad, because I mean, if you go back to Blackstone in New York, it was like, okay, this is easy compared to, not easy, but you know what I mean? Like,
it's not
I'm not
as
sleeping at
intensive.
my desk for 2 nights in a row, right? It's only one night.
Yeah, and being cognizant of the fact that people are losing jobs and where the opportunity is like extra incentive to keep going.
But I wanted that. And I said to them, I was like, look, just work me as hard as you want. I mean, I'm 20, I don't know how old I was, 24, 25 years old. I was like, I can handle it. But what I really want to do is I want to get as much experience, as you say, packed in a very short period of time. So if I can do 14 years worth of learning in 4 years, that's just going to benefit me later on.
You left to set up Mercer Real Estate.
Yep, that's right.
In 2010. Talk to me about that. How did that come about, and why did you decide to set it up?
Yeah, another one to thank Richard Croft for. Actually, it's a roundabout way, but actually probably all goes back to him. So in 2008, a guy, Brandon Holohan, who then became my co-founder of Mercer, showed up into the London office, and he joined, and the two of us were immediately the best of friends. He is such a great guy, and we were just on the same wavelength. I mean,
same age,
mid-20s. Yeah. Same age. Different life story. He grew up here so his father got sent out here during kind of the Big Bang, or just after that, Morgan Stanley guy. And so Brandon, I think, moved over here when he was like 8 or 9 years old.
From the US.
And then went to university in the US. Worked for Morgan Stanley for a couple of years, and then came out to Westbrook here in London. So we were just, brother from another mother kind of territory. And we were working together like crazy hours. And actually it was his relationship with Richard that ended up bringing in that project. And I remember one Christmas, it was late 2009. And I think Richard was like, look, we've got a timeline on this deal. Like, nobody's around London, especially in 2009 too. A lot of people just kind of said, I'm packing up shop. And we were there in the office. So he pitches this deal to us, and we're like, I guess so. So we start putting all of the materials and the analysis together, and we were working on a weekend. And it was in between maybe Christmas and New Year on a weekend in London. And we were at Berkeley Square House, and that, despite an amazing location, that building has like long exceeded its sell-by date. And anyhow, the lift breaks down, and Brandon and I are stuck in the lift. And seriously, we called the lift engineer. They're like, oh, the engineer, he lives out in Essex, or somewhere really far out in Suffolk or something. And it's going to take him 2 hours to get into London to fix this thing. And we're like, all right, well, that's it, right? And so anyhow, Brandon and I were stuck in the lift for a couple of hours until they could get this engineer out to fix it. And in those couple of hours, we kind of were just talking about life. And we realized that both of us had a bit of an entrepreneurial spirit. We were both young, like no liabilities at that point. If things failed, we could always just, go back to business school or something like that, right? There was always other opportunities at such a young age. And I said, well, why don't we maybe think about doing something together? And then that was the genesis of that. That's kind of how it started. Stuck in a lift working on Richard Croft's project, and I think probably 7 months. It was the summer of 2010. We ended up leaving together, and our first office was over in shared space that like a friend of ours gave to us. And that was over on Ironmonger Lane across from the Mercer's Hall. And we were like, okay, Mercer, there's a Mercer Street in New York, there's a Mercer Street in London. This name kind of makes sense. So we went with it. And, subsequent to that, obviously we changed our name. I think some of our first meetings with our now LPs, they were like, do you realize that there is a company called Mercer and they're huge and a lot of people are just confusing you. So can you please change your name? Which we did.
Yeah, it'll work. It'll work maybe when you get an LP inbound you thinking they're the other Mercer and you take it and close it and then they quickly realize that it's not the case.
Right.
Right. One way to kind of see the business. But yeah, you switched from Mercer Real Estate to Castleforge.
That's right. That's
so
right.
You could have and own your identity without the confusion. So is this you and Brandon? What was the strategy? What was the plan? When you went to leave.
I mean, how
did you finance it?
There was no plan and strategy. I mean,
it was just a basis of we've got a bucket load of experience here at Westbrook through the GFC.
A small bucket.
Right. Youthful optimism and naivety,
that's right.
liability.
That's right.
Let's see if we can just do it ourselves.
I think that's right. And, and I think that we knew that there was no money that we had. We hadn't tied up a deal. And by the way, actually to this day, I ran into the Westbrook's founder. I think I was out fundraising in Asia and he was out fundraising or looking at they still have a Japanese presence. So run into each other in a hotel somewhere in Tokyo. And he said to me, he's like, the one thing I do remember is that when you left, some people try to leave and they like leave with a deal or they leave with an investor or they try to have conversations with investors. And you left and you were just like, I don't need anything. I don't want anything from you. Like, we're just going to have a clean break, have the relationship very good, and then see if we can do work together afterwards.
Which is very rare.
Well, yeah. I mean, we probably didn't even know any of the investors, quite frankly. But no. I mean, we didn't try to leave with something, and actually, what ended up happening was they hired us 4 days later after we quit, because they were bringing on a couple of new guys in the office, and they hadn't joined yet, and so they were like, okay, look, in the meantime, do you just want to work for us you left in a good way, like good faith. We still really like you guys. Do you want to just work with us? So actually, even though we didn't leave with anything, they ended up mandating us on our first asset management project, right? So, the guys over there helped keep the lights on, and I'll be forever grateful to them for that. So we did that, and then we took on 3 or 4 other development asset management mandates where we were the operating partner to either private capital or private equity capital that we had got to know over the preceding couple of years. So that, actually by the end of the first year, I think we had 4 or 5 projects on, and then that kind of, right, and it's asset light. I'm not investing. There's just some friends and family capital that we're raising, and that's pretty easy to raise if you're just kind of, trying to get tiny amounts of capital. And so we did that, and then that's kind of how it started. And we kept it pretty lean. I think we were probably only 4 employees until 3 or 4 years in.
Wow. So you left, retained a good relationship, picked up your first instruction or your first bit of revenue on a deal you probably worked on previously. That kept the lights ticking on while it gave you the bandwidth and headspace to think, actually, what is the plan? What is the strategy? And how do we effectively grow this thing?
Yeah, that's right. That's right. And then we would just take on advisory mandates to kind of keep the lights going. I think we always knew that we wanted to go into the fund management side, but I think we also recognized that our real skill at that point in time that we could pair with the market was more the development and asset management side. Because what is development and asset management other than kind of grit and determination, right? And 26, 27-year-olds have that in bucket loads, and they have time on their hands, and they can eat pot noodles, and so there's not much of an overhead. But at the same time as well, like really venerable firms were not raising capital, so we weren't kidding ourselves. It's like, we're not going to go out there and raise a fund. Like, nobody even knows who we are. So So it was very much, okay, let's do things on a deal by deal basis from the start, where we know that it's a pretty low hurdle for people to hire us. Yeah. And then we'll grow the business that way. And then once we get a track record, then we can go do that.
You can build a little bit of a balance sheet, just kind of roll the fees in and keep.
And when the market improves and everything like that, we'll go out and we'll raise capital.
So you picked up 4, 5, 6 of these mandates, all office focused at that particular time, or was it?
Yeah, they all were.
Yeah, because that's where the opportunity set was.
It is, but I mean, I look at there was just 2 of us with no real balance sheet or anything like that, and I kind of think about, well, what's the overhead required to run a multi-let industrial estate across the country? More than 2 people. And so we didn't have that. And so we said, well, look, if we can kind of take the tube to every single one of our buildings in London, and from an office perspective, what you're also doing on these office redevelopments and refurbishments is you're leveraging a huge team, right? There's the architect and the project manager and everybody. And so that the deal's kind of paying for that. And so the actual operator, the GP, the development manager, doesn't really need a lot in terms of personnel. Yeah. So we thought, and then retail was even the other direction, probably from multi-let industrial. It was like, well, first off, we don't have relationships with national retailers. Second of all, like, it's almost an operating business at that point, managing like inline shops in a shopping center. So it was almost process of elimination combined with the fact that Westbrook had always been pretty big into offices. And so we had done a lot of that, and we had developed relationships in the London market. But we said, okay, look, we need to focus geographically in probably one location, London, because we live here. And then we also need to probably go into a sector that doesn't require tons and tons and tons of people. And that, for that moment, was offices.
How did you scale the business after kind of picking up a few of those mandates?
Just pick up more of the mandates. I think that we probably had 4 or 5 projects on at any given point in time up until about 2014. And then we ended up exiting from everything by 2015. They had done very well. And then that had given us, the firm, a bit of a balance sheet as well that could then go use as GP capital to commit to a fund. And then that was also, it coincided with a time that I think American investors, North American investors, were back into the European market, wanting to allocate to London, wanting to allocate to offices. And so as a result, it was like, well, we were the American guys who had a pretty good track record at that point. How couldn't you, right? It was 2010 that we started, right? So
no legacy.
No legacy. Timing's easy. It's like you kind of buy stuff and things go up between 2010 and 2014. And so, yeah, it worked out pretty well. And so then that was the next jump, is when we had kind of a fund that was, mostly like deal by deal type money that we could use. But in reality, if you're talking about actual institutional fund with, pension fund backers or everything, that was 2015. And then you could kind of scale from there.
Yeah, because I'm just trying to think other people who maybe set up a business, that transition or that journey from we're employed to, right, we're going to quit. I've got a rough idea in terms of how and what that looks like, how you then take the business, or how you take the idea and then how you actually execute that. So it's kind of advisory mandates for a period of time, get some revenue in, prove the track record, and then, sell out, I guess, which means you cut all your recurring revenue streams, but effectively you're able to crystallize some sort of promote or upside, which gives you the basis of a co-invest to then actually spend money on the government, the governance and the other kind of rigor that comes with trying to scale or set up, be a fund manager, right?
That's right. And at the early stages, I'd say a couple of things. Probably LPs are probably more willing to understand that maybe you don't have the same infrastructure that like a Blackstone does. So they know that. They're not expecting you to have that. Although I would say that 10 years ago versus today, even at the early stages, I think the expectation has grown. I think
how sophisticated or capable you need to be.
And what probably overhead bar? And the bar, not in terms of like skill or capability, more like the overhead and the fund management, infrastructure. And so I think it's probably harder today than it was 10 years ago to go from being a developer asset management company to being a fund management business.
And is that because there's many more options today in the market, or it's the fact that the people making the decision on where and how to allocate capital are less likely to get fired if they allocate it to a more established player than a kind of a more, entrepreneurial?
Well, there
startup?
definitely are. I wouldn't say more, or because a lot of firms disappeared between 2007 and 2010, but then a lot of new ones came about, right? Really, like KKR and TPG didn't have fund management business, real estate fund management businesses before, say, 2009. But then, terra firma doesn't exist anymore. So, there was the process of creative destruction in the industry. But I would probably say that the sophistication of the mega funds has become so great that I think when LPs look at what services and infrastructure they're getting with one of those mega funds, and then they kind of turn around to small cap funds and they're like, well, why can't you do that? And you're like, well, because we're not Blackstone. Right. And so the level of expectation, I think, has given the consolidation that's happened in the industry, I really think that the level of expectation, the bar has gone up. People always talk about like the barbell, get your beta on one side of the barbell and your alpha on the other. But it's hard to allocate to that beta and then not sort of expect a lot of that infrastructure and those practices to filter over to the alpha side. But it's also hard to expect that because they're not huge organizations.
And I guess the other part is now, if we bring it forward to today, there's that wider structural change where, some of those big mega funds are getting much bigger. And then, LPs are taking a proportion, whatever proportion that might be, and they're allocating that to more specialist managers to be more geographically and stock picking focused.
Yep.
How hard was it in 2014-15 to raise money as a first time fund management business, kind of transitioning out of deal by deal? And you obviously kind of touched on a lot of US capital coming over. How challenging was that? And what was your strategy in terms of how you go about doing it?
You might be expecting me to say really challenging, but it was worryingly easy or surprising. It was easier than it is today. There was a weight of capital that was looking to get into Europe. And looking to get into offices had done very well from 2010 to 2015. Europe had done pretty well from 2010 to 2015. And a lot of the fires that were in institutions' portfolios from the GFC had been kind of put out by 2015. And so I think a lot of North American capital, European capital, endowment and foundation capital was looking to deploy capital into Europe and specifically into London and into offices. So I think that our age was obviously such that was hard. But we had a pretty good track record, as you say, with no legacy issues. And we were in the sector that people wanted to deploy into. So I would say that is much more difficult today if you are deploying into that sector. I mean, and you raised a point of investors wanting to allocate into certain geographies, into certain asset classes. That's very much true. Now, but for small specialist funds, that's scary because what if you're not in that sector that people want to allocate to?
At the right time.
At the right time and the right place, exactly. So I think a lot of people's careers have to do with luck. And I would probably say that what happened for us between 2010 and 2015 was in, I wouldn't say in the majority part, I don't know how much of it was luck, but a lot of it was luck.
How much did you raise for Fund 1?
230 million pounds. And if you remember, that was actually when I got here, the pound was at 2 to 1, or just a little bit lower than that. I mean, even back then it was probably 160 or something like that. So, it was $400 million
for a first-time manager.
For a first-time manager and two guys who are 32 years old. So that's why I look back on it. And you asked me like how easy or difficult it was. I'm sure that there were moments where I thought it was difficult. But I kind of look back on it and I'm like, man, we must have gotten lucky at at multiple stages of that fundraise in order to get that done, because I can't see the equivalent happening today.
And you're competitive on your fees as well the whole way through?
We were.
So it's not like you kind of chipped or, you made it, you reduced your economics. So
no, we didn't reduce the economics, although we did throw in a lot of services that we didn't charge for. And we never did charge for them. So I don't think it was like weird for us, but it was only kind of subsequent to that. Like we didn't charge leasing fees and development management fees and all those sorts of things. It was just grouped into the single fund management fee, which in retrospect is actually a pretty great deal for investors, especially when you're doing so much CapEx, because at that point it's not coming out of the fund. But it was nothing like where we were giving half our fees or something like that to somebody. So yeah, I'm actually really surprised, and I think that a lot of it was luck.
And what was the hardest thing at that stage? You raised 200+ million. Was it then building the team or attracting the team to come and deliver on the kind of the vision and mission that you'd raised that money for?
No, it really wasn't. I mean, early days, we let's see, before Brexit, because the fund closed in 2016, like just around Brexit, and it was probably 50% deployed. We had early realizations were great, and we had a great team of probably 15 of us, maybe 15 to 20 of us. Keep in mind, obviously, that's not all investment professionals. There's a lot, once you get to the fund management side, I mean, there's just a lot of back office and mid office that you need to have and the infrastructure in place. But no, the team grew really organically, actually. It always grew pretty organically. I mean, we never took any outside money for like working capital or anything like that. I'm not saying that that's necessarily a good or a bad thing. We just didn't. And so what it meant is that there was always a governor on how quickly we could grow. And we're kind of forced to bootstrap ourselves. But actually, I think it worked out really well, because in my experience, when people throw money at you to go build out a team, you sometimes make decisions that are, not as frugal as you would otherwise. It does allow you to grow faster, for sure, and sometimes that works out really well for you. But there's probably a high beta around that, right? And sometimes it doesn't. But when you kind of are forced to grow at a measured pace, you sort of learn from your mistakes along the way, so that you don't go make 20 of the same mistakes before you realize that it's a mistake.
You're on Fund 4 now,
yep.
if I'm not mistaken.
Yep,
talk to me, just before we come on to kind of Fund 4 in the present day, talk to me about Fund 2 and Fund 3. How much did you raise, and what was the kind of the strategies related to those fundraisers?
Yeah, we raised 270, I think, 275 on Fund 3. That was when we had to cut short because of COVID. So we have a history of raising at very difficult times in the market. Brexit for Fund 2 was the kind of the final bits of the close, COVID for Fund 3, and then now with interest rates and kind of the world going topsy-turvy on Fund 4. And the strategy there was mostly offices for Fund 2 and for Fund 3, although Fund 3 we added in residential. So we started to invest in some multifamily projects, small projects where, but unbroken blocks of flats. And we got into a strategy of being able to kind of consolidate all of these. So we would buy a small block of, 50 flats on average. And then once we had 40 of them, right, it was a portfolio of 2,000 units. And that's where we are today. And then we were always opportunistic as well. When COVID happened, the first thing we did was hire a hotel specialist and then invest in 4 hotels.
Because?
I mean, honestly, it was like the Westbrook playbook after the financial crisis. I remember looking at like an investment committee memo when we were doing at Westbrook. It was the U.S. guys were buying the Four Seasons over in Boston, and not Lincolnshire, other Boston, and it was like negative NOI. Right. For I don't know, the first year or two or foreseeable future. It was like, I don't know when this is going to turn around. I don't know when people are going to come back to Boston and want to stay at the Four Seasons and spend money and all that. And I do remember the senior guys at Westbrook saying, forget the NOI right now. It's like a negative cap rate. Yes. But the per key, it's like you couldn't even build it for that. And you're getting the best hotel in Boston. at a price that's lower than the cost to actually build it. And it's a very cyclical market, and it will come back. And it did, right? And here we are, I'm just kind of thinking about exactly that 10 years later, whatever, 12 years later. And so what we said is like, we should buy select service hotels in very tourist type destination locations, which have been hurt, but people are always going to want to go to Edinburgh. Okay. I don't know how long this thing's going to last for, but if I can buy a hotel, and in this case, it was around, let's call it 100,000 a key. It's like, you can't build a hotel for 100,000 a key. And it was a well-located freehold hotel in Edinburgh. And the level of difficulty, degree of difficulty, I remember saying, this to the team at the time. I was like, just make sure you don't do anything too hard. Okay. Because this is all about a disrupted market and taking advantage of a disrupted market. There's no capital in the market, like pretty much at all, but then certainly not for hotels and hospitality. So let's not go do big heavy lift projects on refurbishments. Let's buy stuff that have messed up capital structures, or the person can't hold through COVID, but we can, and we'll just buy it unlevered, and then there you go. So we've actually started to sell some of those off at basically our underwritten returns. A little bit early, so probably outperforming.
Literally just bought really well, held through conviction, not even plowed that much capex into them at all, but just bet on the fundamentals and a time period and get your value add returns.
Yeah. Oh, for
4 or 5 years later.
Oh yeah. 4 years later, maybe 3 or 4. It's look, I don't think anybody could have at the time said, okay, COVID is going to last for this long, right? But you're buying fundamentally good real estate that is operational in nature. So people don't necessarily have the wherewithal to hold because there's negative operating costs that are happening at the time. And as long as you're buying unlevered, you have staying power. And then it's about kind of making sure that what you're buying is say like tourist destination locations. So we bought two in Edinburgh, one in Bath and one in Cardiff over by the rugby stadium. And so we're like, whenever tourism comes back, these are going to be the hotels that come back first. And they were. And then even today, cap rates for hotels are probably 150, 200 basis points outside of where they should trade. So they're actually trading at a cap rate discount to 25, 30 years worth of Edinburgh trading. But the NOI has made up for that difference because ADR performance was so strong when people came back, right? And also hotels we wrote about this in one of our research letters to our investors. Hotels have always actually done very well in keeping up with inflation. And so it weathered the storm of 2022's inflation bout really well. And so, your ADR grew. Sure, you sold it at, you wanted a 6 cap, it's an 8 cap. Okay, but ADR is 35% up. So net, you're kind of per key where you wanted to be. And it didn't take you that long to get there.
So in terms of the fundraising piece, was it like blind pool?
Yeah, they were all blind pool funds.
Rather than specialists, which enabled you to kind of spot the opportunity to go, right, we're going to buy these hotels.
Yeah, that's right. That's exactly right.
Property is a people business, hence the name People Property Place. Business has been tough the last couple of years. Get the people aspect wrong, business becomes impossible. Get the people aspect right, it's still hard, but it's manageable, much more enjoyable, and you're much more likely to hit your goals. So if you're looking to add top talent to your team in 2025 and you're open-minded to an alternative approach and you're keen to make business a little less hard, drop me a DM. I'd love to have a conversation with you to see how Rockborn could potentially help you with your human capital requirements. Right, let's get back to the podcast. Fund 4, how much have you raised for Fund 4? Bring it around to kind of present day. And if I'm not mistaken, you've made a play into the data center space as well.
We have. I'll get to that and kind of why. But in terms of capital, it's over 400 million now. Not all of that is primary capital. Some of that is co-investment capital. But it kind of allows us to do what we need to do and have a lot of dry powder to be able to invest. But what I can say is that this was a very difficult fundraising environment. This is
the hardest out of all of the ones you've been?
Certainly the hardest out of the 3. Was it harder than GFC? I don't know. I wasn't raising capital at that time. I'd imagine that it was equally difficult because what happened after the GFC was, and especially like you have to think about like who we are, right? So who allocates to a sub 500 million pound manager in a specific geography that has a predilection to a specific asset class? Mostly endowment and foundation capital, like the Yale model, that kind of stuff. Well, if that's the case, then you have to have those investors have capital and liquidity in order to allocate. Post GFC, what ended up happening is none of those investors were getting distributions. They just kept getting capital calls. And so they had really no money. Everybody talks about like a denominator effect and balancing of portfolios, but I think it's more numerator effect. It's like when you're not getting any DPI from your other, private equity investments. And a lot of these guys are 30, 40, 50% allocated to alternatives. So they're in private equity funds that won't be distributing for the next 5 or 10 years. So they're like, well, I just don't have money to allocate. And I think that's also what happened post GFC.
Yeah, I'm just thinking, if someone listening to this is trying to keep up with that,
okay.
in simple terms,
okay, let me try.
Like these funds have allocated money, but they've the managers have kicked the period in which they're going to send money back to the investors, distribute money back down the road.
That's right.
Because they don't want to sell now because they think it's going to be worth more in the future.
That's right.
But
and
what
these are
that
like
does,
10-year life vehicles, so they can do that.
But it causes like a plumbing issue in the fact that there's
That's
no
right.
new liquidity to deploy into new assets.
And the flywheel stops spinning.
And the flywheel stops spinning, which makes it incredibly hard to raise capital.
That is exactly right. So, and that happened after the GFC. And it's happening now. So I'd imagine that it's a pretty similar type of environment. What might actually be different now is I think post GFC real estate wasn't such a beaten down asset class. I'd say that's one thing. And then the second,
it was more of a core. It was never a core allocation.
No,
but it was
right. No, now you have other options to allocate to, right? So if you want, especially with interest rates where they are, well, you can allocate to infrastructure. You can allocate to private credit. You can allocate to. There's lots of other ways. Especially if you're like a core plus investor or value add investor, like there's a lot of other ways to get a 10. And that
without
wasn't
taking the risk
the case.
Real estate does.
Yeah. And then there's, then there's a lot of other things I think that are probably holding Europe back from fundraising, which is a lot of the investors that we're talking about, endowment and foundation capital. Well, okay, Harvard's endowment is like $100 billion, right? So they've got a lot of money to invest. You don't have the same university systems here that have $100 billion to invest. A lot of it is North American capital. What's happened over the last 10 years is that Europe has underperformed North America massively. Whether you can probably cut it 100 different ways and say it was all down to tech and it might have been actually, or down to the ability to move states and the growth of the kind of smile states, as they say in the US, or the Sun Belt. Sure, whatever it was, real estate returns in Europe generally underperformed real estate returns in the US, like geography for geography, asset class for asset class, all that kind of stuff. And as a result, I think a lot of North American investors are like, why am I going to invest in Europe, right? The narrative has become, hey, Europe's a museum, right? It's a nice place for me to go on like a summer holiday, but I don't want to invest there. And so I think Europe and then real estate has like a lot of headwinds for it, in addition to just investors not having the cash to be able to allocate. And so there's a lot against fundraising right now in Europe for like mega cap funds.
And even Middle Eastern or Asian capital is like, would rather allocate that maybe internally or towards the US market, regardless of what Trump is doing.
Well, certainly what is the case today, that was not the case 15 years ago, is the Middle East has a real economy to allocate capital into that's growing, and that there are really amazing investment opportunities there. Plus, there's a real push, I think, from a lot of these Middle Eastern countries to try to keep the capital domestically, because there are great opportunities there. And so I think that there's probably alternatives there in the Middle East that maybe weren't necessarily there 15 years ago. However, I do think that there is a lot of capital formation in the Middle East, right? I mean, literally, oil coming out of the ground, money coming out of the ground. And in Asia, there's a lot of capital formation. One, because these are such fast growth countries. They're at that point where their savings rates are pretty high, and then that money has to be allocated somewhere. And then there's not like a developed pension market or capital markets in the same way that there are in other countries. And so I think there is a lot of capital coming out of Asia, and there's a lot of capital, or at least being formed in Asia, and a lot of capital being formed in the Middle East. And then the question is, where does that capital go? To your point, we've probably, I think maybe 2-3 years ago, we saw this all happening, kind of saw a little bit of the writing on the wall. I don't want to say that it was all foreseen, but I think we got lucky in some cases. But we kind of executed our own Asia pivot, about 2-3 years ago. And I spent a considerable amount of time in the Middle East and Asia over the course of 23 and 24. And so a lot of our capital actually has started to come from there. And a lot of our business has started to come from there. I'd probably say about a third of our business now is Middle East and Asia, as opposed to North America. So we were very fortunate in
terms of that pivoting
yeah,
and making sure that you were able to still raise capital.
That's right.
So Fund 4 raised 400 million or so.
Yep.
What was the thesis, or is it more of the same UK, European value add plus returns, 5-7 year hold periods?
I think that these next couple of years will look similar to 2010 and 11 and 12 and 13 for London offices. I really do. You've got an out of favor sector. The difference now actually is that it was sort of, there was a moment in time where everybody I think was like looking at offices, ourselves too. I mean, worried about the business, saying, well, our office is just the next retail. Like, there are great fund managers that were in the retail sector and specific to retail. But, so the point I made earlier, it's like, if that's not the sector that's in favor, and if you seriously cannot get institutional capital to buy into retail for like 10 years, you don't have a business. And so, was that going to happen? And then there was a lot of narrative post-COVID of, well, offices are structurally challenged. There's never going to be a need for them anymore. And, that's, I can tell you that's not the case. Or that it's changing. But I think that the point of like maximum negative pessimism on the office market, certainly from a tenant perspective, I'm not even sure if there was one, because rents have been growing the last 4 or 5 years. But from a capital markets perspective, has probably been reached.
Yeah, Richard Croft talks about trying to raise money at Martley Capital now for regional office strategy, and he says you talk to an investor and his word said you'd offer them a syphilitic culture or an office strategy, and like 50% of the people would take the syphilitic culture, right? So
Richard's got away with words. Yeah, no, I think he's right, and that's probably not too dissimilar from what he saw with multi-let industrial 2008, 2009, 2010. And so I think where I probably wouldn't disagree with anything that he's saying. And we have a regional office portfolio that we still have, the window of liquidity, when it shuts, right? And so there's nothing you can do about it from the capital market side. But from the operational side, rents are growing. Rents are growing massively in the regional markets. And we started our own serviced office business, which operates a lot of the space in
clockwise.
Yeah, clockwise. So it operates about half the square footage across that portfolio of 17 assets, 13 in the UK, 4 in Western Europe. And our rates are desk rates are growing, occupancy is growing. Some of the growth, I'm even just, I kind of have to do a double take, speaking to the tenants. It's like, wow, I can't believe that, they're like, yeah, we're growing. Okay, I'll give you a story. In Belfast, we have a project where a very large international publishing company started with like 2 desks in our space. Then they went to 14 desks. And then they just took a whole floor on a traditional lease. There's another company in Belfast that was in our building, big American insurance company. And they started, I think, in 2, they went to 20. And they grew so fast that we didn't even have space to offer them because our building was full. They're now at 200 employees. And I think that happened over the course of 3 years, 4 years. And it's like, wow. I mean, I can tell you that I'm sure that the GDP of Belfast is not growing at exponential rates, but the occupier market is doing very well in some cases.
So why is there such a disconnect between the occupier and the capital markets then?
So, I mean, I my I think there's a lot going on. There's so many answers to that question, and I think they're all right, and none of them are right. So I'll try to take a stab at the biggest misses that I think the market is getting, and I've written about these things sometimes. So first off, I think everybody thought office is going to be the next retail. So literally just shutting their mind to I do not want offices. I think a lot of offices were purchased in 2016, 17, 18, 19, 20 that were not great offices. And I think that there was a little bit of a structural shift in what tenants want, and maybe not even a little bit of, but a sizable shift in what tenants want. And so I think that there's some bad experiences on those offices, both from a cyclical and a structural perspective. And then I think that, that causes people to extrapolate and over-index to the retail market and say, that's what happened there. I'm going to get out of this right now because I don't want to be stuck in an asset class that doesn't have liquidity for 10 years. Right.
I've been burnt too hard before.
That's right.
And I see this story coming.
Exactly.
And
actually, is it just a confusion the other way around? And you're confusing now a cyclical shift for a structural shift, when in reality, no structural shift is happening. Or not one to the extent that people think it's happening. Look, I mean, from our perspective, retail and the rise of Amazon, what you had was you had a monopoly as a retailer on distributing goods one way to your consumers, right? You had a monopoly over that distribution channel, which was the retail sector writ large. And then Amazon comes on, or all the other online retailers come on, and they say like, okay, actually now there's an oligopoly. There's two of us, right? And now we're competing against each other. So what happens when a monopoly turns into not a monopoly? Rents fall, right? They have to. So I think a lot of people looked at offices and were like, well, there's this Teams thing in Zoom, and that's the competitor to the office space. And you know what? Maybe it is, but I don't think so. And I don't think at least to the same extent, because it's not the same product. Listen, if you have to go to John Lewis to do like home goods shopping or something like that over a weekend, I can't think of anything that would be worse. And by the way, if you basically just do it on Amazon and find the exact same product, you are getting the very same product delivered to your house, and it's easier. You cannot tell me that working on a Teams call is the same as working in an office environment. And I don't want to argue with anybody about like productivity and relative productivity. It doesn't really matter, but it's like, it is not the same product. Now, there may be times where Teams or Zoom is entirely appropriate. Okay. But not 100% of the time, which is really the case with like retail and industrial distribution. So anyhow, I think that there's a lot of that, and there was so much noise post-pandemic, and like everybody professed to be this like guru of the future of the workplace, right? And so that kind of just created its own narrative, right? And that narrative developed, and the narrative was you don't want offices. And I don't know. And then narrative shift, right? And suddenly the narrative shifted that offices are bad to, well, maybe some aren't that bad. And then,
what do occupiers actually want from an office?
Well, what do occupiers want in an office? That's right. But I tell you, the biggest help that office investors probably got over the last couple of months is John Gray saying that offices are okay to invest in, right? I mean, that alone, honestly, probably shifted the narrative for a lot of investors.
Well, I think you're alluding to Blackstone and the can of ham going from them looking at buying it at 625 to a 6 cap. And
yeah, I mean, that's part of it. And then they're buying in New York, and there's the recognition that and I think they just bought JLL's building over in Tokyo, or in the process of. So, and then that's a beautiful office building, really well located in Tokyo. And there's at least a recognition that it's not just black and white. There is nuance to it, and some offices you do want to buy, and some you don't want to touch.
So what offices do you want to buy, and what offices don't you want to touch?
Right. So I will say that I do think a structural shift happened, and that structural shift brought about by whatever, whether it was the pandemic or not, or whether it was happening anyhow, I do think there's probably a recognition that maybe we don't need so much office space. So there's probably an overall reduction in the amount of office space demanded, or at least there's a pause in the growth, right? So that growth goes to zero or negative. But what I think that's forced tenants to do or want to do is improve the quality of their space and the location and the quality of the location. So we've got this slide in our 2016 deck or something like that, where we compared 2016 to 2006. And what happened was between 2006 and 16, the rental gradient, that is like how big the discount is between best location and kind of secondary locations, flattened out, right? So, you had the core city at a level that was like not too far off what Shoreditch and Clerkenwell and Southwark and all these previously secondary locations were renting at. And I think I think what that's indicative of is the fact that office space creation in the core didn't keep pace with demand, because tenants were forced to go further out. But now that I think there's just overall probably a reduced amount of office space demanded, combined with not much office space being built, means that gradient is now kind of becoming steep again. And so you have very high rents in the core, and you have much lower rents in even good secondary locations, and then just no bids in bad secondary locations where they just shouldn't be offices anymore. And so that's the biggest change that's happened, I think, structurally, which means that what you want to focus on location more than anything else. It's the amenity you can't change and that no amount of money can change.
Which is like rule 101 of real estate investing, right?
Well, yeah, it is, right? But then even that goes through cycles, right? I remember we were investing in Clerkenwell back in 2011, and the rents were £30 a foot, right? And they went to 70, which was on par with where the city was at that time. I mean, at that time, and back in 2011, I think the city was probably 55, 60, and Clerkenwell was 30, right? So it was a 50% discount that went to a 0% discount. And I'm not saying that it's going to go back, because I think Clerkenwell's changed as a location, but certain parts of Clerkenwell probably will go back. Not the not so well located ones where it's 10 minutes from a tube or something like that. So I think it's become that rule becomes more and less pronounced depending on where you are in the building cycle and everything. And I think we're at that point where it's super, super pronounced right now. And I would take a B building in an A location over an A building in a B location all week long. And I think that's what you're starting to see in the market right now, is because rents are growing at such a pace that I'm not sure if tenants really want to pay. Like, there's going to be an upper bound at some point where tenants are like, you know what? The building I'm in is pretty okay, but the location's good. And if you're telling me that I need to double my rent in order to get into a new building just because somebody told me that like all of my employees need an EPC-A BREEAM outstanding building in order to return to the office, I'm not sure I buy that. And so I think that probably your best value for money investment right now would be like your B plus A minus buildings that can be made to be A buildings, so great bones, great facade, timeless kind of facades and types of buildings, but in super, super A locations.
Yeah. And what that just appeals to the kind of the middle chunk of the occupier, like the ones that have got the appetite and need to spend, like the top money,
sure,
always will do. But there's this like the mass middle who will make a call one way or another in terms of how they want to occupy.
I think that's
right. But the
right.
Location is still super important.
That's right. So so if you kind of break it into 4 quadrants, it's like A building, A location. That's easy. That's an easy call. It may not be an easy call for the capital markets. I mean, like you referenced the can of ham earlier. I think that's a great deal, right? I mean, if you're buying a building in an A location at a 6 cap, I would have traded at a 4 cap, right? We were sub 4 at the peak in 2021. That's great. Oh, and by the way, two things have happened. Number one, your lease has gotten shorter, so you're closer to capturing any reversion. And number two, the rents have grown around it. So that building is probably 40% under rented. So amazing, right? And Japan, I'm sure Blackstone had the same thesis because leases are even shorter over there, like 2-year, 3-year leases. So they'll be able to capture the reversion very quickly. And so I think that those are great because those will be like the top buildings that you want to own. But then you're right. There's like at the very bottom, there's the B building in the B location. You just don't want that at all. And then in the middle, you kind of have to choose A building, B location, B building, A location. And if I look at which buildings are occupied and which buildings are not, I'm finding that it's the B buildings in the A locations that are getting a lot more leasing demand than the A buildings in B locations. And that is very much the opposite of what I think a lot of people would tell you, that you need this like ESG all singing, all dancing building. And I think there's a lot of financial incentives for people to parade those as the preference.
In the C locations.
In the B locations, yeah. Right? But it's BREEAM outstanding. I don't, what's wrong? And it's like, yeah, but it's hard to get to.
It's zone 2,
Yeah, or just even zone 1, but I like periphery or, the pain point for tenants on a walk from a tube station is not even 10 minutes anymore. It's probably 5 to 7 minutes. And that may have been 10 to 12 minutes before. So the core is shrinking. And then what the big question is, well, what do you do with the buildings that are in fundamentally not good enough locations to ever be offices again? And I think there's a huge opportunity there for hotels, hospitality, living. I think what's really interesting is London has this, and every gateway market in the world, I think, is going to have this great opportunity to be able to repurpose these buildings into something that people do want, which is a place to stay.
Co-living. I've spoken to a number of groups who are looking at buildings in the city of London, which probably hits that criteria. They're not going to be offices again, but actually you've got a great bone or infrastructure to become great co-living refurb, retrofit type products.
I mean, look at Temple as a location. It's not a great office location, but you're a stone's throw from the Savoy. It's probably a pretty good hotel location. I'd say Kingsway as well. Like
Theatreland, Covent Garden.
Absolutely. I just don't see it as a great office location. It's okay, but man, it's a great hotel location. That's right. Hammersmith. I mean, our second project ever, second project ever, I think, was in Hammersmith. I wouldn't, 15 years later, there's not a price that you could sell me an office building in Hammersmith for that I would actually take that, refurbish it, and keep it as an office building. I just don't think it needs to exist in a way that it did 15 years ago. And as a result, it should be something else. Now, that's going to depend on local authorities and whether, Hammersmith and Fulham or Islington or City or Westminster or whatever allows you to do that. But it's a huge opportunity, I think, for London and for all other gateway cities in the world to kind of repurpose it into something that people really do want.
We kind of skirted around it, but clockwise, vertical integration, owning that business, setting up that business. A couple of questions in here. By owning that, are you in competition with investors? How do you reconcile owning the management company and investing capital with your fiduciary hat on? And why vertical integration as well?
So on that, what we do, what we've always said to investors is we're not going to make any money off this. We're basically just going to use it as a service business. So it charges cost or market, whatever's lower, to service those assets. It's almost like a hotel management company that sits on top of a hotel. All the money, all of the net profits go to the owner of the real estate, the owner of the building, not to the management company.
And the way you reconcile that is, the reason why you do that is because you want the data or the occupancy to inform decision making when it comes to investment?
No, because it's really hard to operate and manage these buildings, right? What I've found is that, we've a team of 3 to 5 people on every single one of these sites. And it gives us such a competitive advantage when it comes to finding tenants, sourcing leads, signing them, making sure that they're happy, that they stay in the building. One of the North Stars for me in that business is our net promoter score. which is, I think at the moment, higher than Apple's, right? It's like 70 or 75. I mean, it's very high. And the reason that's important for me is that's tenant retention. But also just having, I mean, think about it. You got 2 office buildings in Leeds. One of them, tenants are going to be in Leeds. And so they say to you, hi, I'd like to, rent your building in Leeds. Going to one, oh, well, the asset manager can get on site maybe tomorrow or the next day or whatever. And maybe the broker can get there today versus, yeah, we got a team of 4 people. We're here in Henry Woodhouse, right? That's how it kind of functions. You walk in and it's like, oh, sit down, have a coffee. We have a cafe in every building. Have a coffee. We'll talk about your needs, what you want, et cetera. Here's what we can do for you. We can either offer you space that is on a traditional basis, like every other building in this market is going to, or you know what? If you don't want an office manager because you'd like to save some money, we can do all the cleaning for you. We can take all of your health and safety stuff off of your plate. We can do everything for you, and we can do it on a short-term basis. It can be a month, it can be 3 months, it can be a year, it can be 2 years. It'll be fully fitted out. You can move in today because we have a license and it's 4 pages long, so you don't need a lawyer to deal with all this stuff. And by the way, we can get your internet set up today. What would you like to do, right? And the price-wise is not that different.
And if you're going to double your headcount, we can just move you internally and facilitate that, right?
100%, exactly. Or if you're going to reduce your headcount, right? If you're worried that okay, well, maybe actually in 6 months or a year, we don't even need an office because we've gone from 10 people to 5 people. That's cool too. Just reduce the size of your office or actually just take, day passes or something like that for your office. So but that is hard to do, right? There's 100 people in that business that are doing that every day. And that is a level of service and a level of providing the tenant what they want that other buildings just can't do, other owners can't do because they don't have the scale to do it, because it's hugely expensive and hugely complicated to set that up. So we said to ourselves a number of years ago, look, if we can do the hard stuff really well, what we're going to be able to do is provide a competitive advantage to our investors who are the owners of these buildings, to outperform buildings that don't have and offer those services and that level of flexibility or whatever it is, customer service.
And that's why you went for that.
And that's why we went for a vertically integrated business. I do think that we are going into a world where as lease lengths get shorter, actually scale becomes so much more important. Because when an office tenant, I don't know, 30 years ago, used to take a 25-year lease. So they'd take a 25-year lease over a 50,000 foot building, and the owner really didn't have to do anything from an operational perspective throughout that period of time. But if you're now at 50,000 square feet and it's across 10 floors, nobody's going to take 5,000 square feet times 10 floors for even 10 years. You're going to be doing 10 single lettings of 5,000 square feet each. It's probably going to be fitted space on a 5-year deal with a break at 3. So you have 3 years of term certain. It's very highly multi-tenanted, et cetera. And so it just starts to become more and more and more and more complicated. And the more of a portfolio you have and the more you can treat your income stream that you're generating as a portfolio, actually the greater the amount of lease size that you're able to offer on a shorter amount of lease, right? You're kind of going from a world of bulk, ships or whatever to these big container ships where it's like, oh yeah, you want, a one container or I can do 1,000 containers for you because I fit so many on the boat that 1,000 really isn't a very big piece of my portfolio. Whereas if you have a smaller ship, it's like, well, I can't fill the whole ship up with somebody renting it from me for a week or something like that, right? I mean, so size matters as leases become shorter and as operational real estate kind of seeps into the office market, which it has.
And then that's why there's talk about a change in valuation methodology, right? And is that leaning towards more offices being valued on a hotel basis rather than
I think they should, right? And so,
because a hotel, it's one night, right?
Night.
That's the lease. That's the lease length.
That's the lease length. One night. Yeah. I mean, I've kind of mentioned this before to a couple of folks. It's like in the serviced office side, you've got 2 times the EBITDA margin. You have a longer FF&E refresh cycle because you don't need to keep replacing stuff as often. Very little of your profitability comes from food and beverages. I mean, in some cases, some of these hotels are like literally restaurants that you're with rooms above. I mean, the EBITDA can be half F&B or a third F&B. And then, and the lease length is 1 month, but tenants stay for like 3 years. In the hotel, it's one night and people usually stay for like 3 nights. I don't understand why offices should be valued at a discount to hotels. Like all of those metrics are better in the office space. It's just that it doesn't exist yet. People are not really doing that and thinking of it as like an office hotel. But yeah, no, it'll get there at some point. It'll be driven, I think, initially by investors who probably care about cash flow, right? So it'll be like private investors maybe who go in first. I'm not sure if the institutional investors will go in first. Maybe they will, but they should.
Talk to me about kind of the data center play in all of this.
Sure. So I think that it's clearly a sector that is going to grow in some way, shape, or form. I don't think anybody knows exactly how it's going to grow. I mean, I'm sure some people do. It probably like AWS
or John Gray,
or John Gray, exactly. Although actually they're taking a pretty measured approach to it. I mean, I think one of the things that he was saying is that we're not going to just spec build anything, right?
Yeah, they take the lease and then
that's right, exactly. So they're doing build to suit. So I don't think that anybody knows exactly how it's going to grow, but I have a very strong sensation or feeling that it is going to grow in some way, shape, or form. So I think it's a sector that we want to be part of and that we want to get to understand. So we did make a purchase of a data center, but I think for us, it was much less macro driven. It wasn't like, oh, this is going to be a sector that has tailwinds, so just buy and then you'll do well because it's like investing in logistics in 2014, right? For us, it was very special situations driven. And I think that that's going to be maybe the main change in the market over the next 5 years versus the previous 5 to 10 years. A lot of the previous 5 to 10 years was if you got the macro right, you pretty much got the
niche, pick
right.
The sector.
Yeah, that's right.
Jump in.
That's right. Rental growth carried you. You obviously had to be a good investor to recognize that. And you had to be a good investor to operate as well. But, those were strong tailwinds. I think going forward, you'll probably still have tailwinds to sectors, but I do think stock selection probably becomes a little bit more important and the special situation becomes a little bit more important. So, and with offices, that was more like, are you picking the right location where the tenants want to be? And is it the kind of building that actually can be refurbished to the point where it's got great bones and the tenants do want to ultimately take it at the end of the day? So I think stock selection there is important. But on this one, we got hold of an opportunity. We had been looking at the data center space for a while, just trying to understand it and do some mapping of it. And an old relationship of mine from Blackstone actually then turned out to be the CFO of a US operator in data centers, and they were looking to grow in Europe. And so we started talking probably 2021.
The old Blackstone network.
The old Blackstone network. Yeah, exactly. It's a good group. And so anyhow, he was like, look, we don't have on the ground site sourcing capability. We don't understand the planning and development side like you guys would, but we're really great with operators, being an operator, great with tenants, have great tenant relationships, et cetera. So we said, okay, that's a great combination for what the two of us can bring to the table. So they found an opportunity. It had been marketed. It had fallen through in 2021 at a price of, I don't know, let's call it 125 to 150 million. It was a very high price. They were offering it at a lower price. And it was just as capital was flowing out of the market, just generally for real estate. So put it under contract, started to do our diligence, and what was supposed to be probably an 18-day due diligence period to exchanged turned into 18 months. Right. So, and what happens over 18 months, like you have control of a situation, pricing comes down further, you can kind of renegotiate things, you can add things into the contract, you can get structure in your deal that makes your equity work harder. A lot of stuff happened. And then in the intervening period, we actually got confirmation from UKPN about the power, because previously the power wasn't secured. And then halfway through the purchase, the power did become secured. And that, that's a major thing in data centers, is like having secured power.
The thing, right?
The thing. Yeah, exactly. So we were like, wait a second. So we're buying something that was cheaper than, definitely when it was offered as a failed sales process, but it was also cheaper than it was when we put this under offer, but it's lower risk because we now have the power and we've done a lot more due diligence on it and trying to understand it. I think that this probably makes sense from just a special situations perspective. But in terms of what the thesis is, I think the way that I could see data centers playing out is it's actually not too dissimilar maybe from industrial and logistics, in that you've got like huge sites where they are going to be like data center campuses, right? And they need 250 megawatts, 500 megawatts, 1,000 megawatts. And people like Blackstone are going to build them out, and they've got the capital to do that. And that's kind of like a huge Amazon distribution center, and it's 2 million square feet, 3 million square feet, somewhere where it makes a lot of sense because, it's right where the ships come in and unload. This is right where like the undersea cables come in and unload, right?
Yeah. And actually pinpoint the perfect
exactly. And then it's about like getting the consent and rounding up all the power that's required, which is hugely expensive, hugely time consuming. You need to have, expertise in that sector and everything like, okay. And then somebody like whatever, Amazon takes it for 20 years, just like big box logistics. And then I think the other end of the spectrum is going to be more about last mile distribution of content. So instead of goods, it'll be digital goods. And that will be around population centers because it has to be low lag, asynchronous. And that's hard to assemble even 10, 15, 20 megawatt sites that are close to population centers, especially when power is in such short supply. And I think what this site was a co-location center, which meant that, you kind of rent it out in individual racks and everything, or groups of racks, to tenants who want to take it to use it as storage space. Yeah. But I think it may shift more towards what like a last mile distribution center is, that it's not about storing goods there. It's about distributing and passing goods through there. So proximity to population with large power allocations then matters. And that's what I think we're going to try to repurpose this one into, versus, keeping it as like a co-location facility. Because I think that maybe is a direction in which, but again, we don't know. Right now, it's working phenomenally well, actually, even just as a co-location center. Rents are going up.
So your downside,
yeah, exactly.
A underwrite is
rented,
kind of covered.
Absolutely.
You're just looking at how you can create that.
How can we yeah. I remember when I was at Westbrook, we within that portfolio, or maybe it wasn't, but there was a huge 100,000 square foot warehouse in Hayes, and I don't know what the tenant was, but they were storing stuff there, like storing clothing, and I think they're paying £7 or £8 a foot, and it was 100% site cover, built in the 50s or 60s, and the whole point of it was literally to store stuff, and so you wanted like a huge amount of site cover, and I think what ended up happening, I left, but then I'd heard, was actually best thing to do is knock that down, reduce the site cover massively, turn it into a distribution center, and rent it at not £8 a foot, but like £40 a foot, right? And that £40 a foot over a smaller amount of floor area, massive uplift in rent. Plus, then it appeals to Amazon, who then takes a 15 or 20 year lease over it because it's their last mile distribution center. And then you have that long-term credit as well. Yep. Amazon wouldn't take a 60,000 square foot distribution center somewhere along the M1, right? They need it close to a population center, and that's why they would take that. And I think that at least maybe that's a potential way in which some of this goes. So I think that there'll be sort of a bifurcation, at least, of the types of data centers that people are going to want. And some people are going to have the scale and the capital ability to go really big. And then I think there's going to be the small kind of special situations opportunities that we can take advantage of. And that's probably the direction that we'll go. But again, we probably, we're so early in our ventures there that there's a lot of, known unknowns, unknown unknowns. And so I don't think we want to go plowing into the sector before, and we've done a lot of work, but there's still always going to be learning. And so I don't think we want to plow into a sector before we've learned from, each step of the way.
Before we went live on this podcast, you said, how long is this? And I said, we'd probably talk for about an hour or so. And you said, an hour? That's a really, really long time.
It is a really long
time. We're approaching an hour and a half. And I'm mindful of our time. And I feel like we said earlier in the conversation, maybe I'll come back for round 2. You definitely have to come back for round 2 because I feel like I could talk to you for another hour and a half. I feel like we've only covered a small proportion of what we wanted to speak today.
It was fun.
Trying to kind of pull this to some sort of close and leave the door open for part 2 in the future is question I ask everyone is, if I give you £500 million worth of capital, who are the people, what property, in which place would you look to allocate that capital?
Yeah, I think I'd go back to my answer before of like really good quality office buildings in central London. Just exactly what Blackstone's doing with the Can of Ham. I think this morning somebody told me that Delancey and Aware Super were buying Finsbury Circus House. That is a massively under-rented building built in 2013-14, so reasonably modern, timeless facade. A Crossrail at Moorgate is a game changer for that location. And you can probably buy, if you just do the math of like rent divided by cap rate, where rent and cap rates just currently are today because of the sector so out of favor, you get to a level that's probably less than your build costs, and it's rented. So I think that being able to buy things for less than replacement cost for sure, and even in some cases, I think even construction cost. I think SVP just announced that they were buying Senator House. I think it's not a particularly amazing building, but it offers great big floor plates in a very central location, and they're buying it definitely in that case for less than construction cost. Like, I just think that that's probably a pretty good place to deploy capital. And you can deploy a lot of capital too, pretty quickly, right? It's not like you have to aggregate a portfolio of very small assets. These are big assets that if you're trying to deploy 500 million worth of capital, you can deploy very quickly and in a capital market that is out of favor, and yet with a very strong occupational market. I think that that's probably what I would do.
And how long would you say the window is to be able to take advantage of that?
I mean, it's not more than a couple of years. It's probably not less than 6 months. And then, so the question is like, do you want to, I think you should be doing it now. I would probably be doing it. I'd say that particular window of opportunity is not more than a couple of years. I do think that there will probably be the window of opportunity to continue to invest into the London market, not just for this fund for us, but I think probably the next fund. And I think there's going to be a lot of adaptive reuse opportunities within the London market, just given the structural changes that are happening in the office sector. So I think that window of opportunity, the more heavy lifting side, is probably 5 to 7 years. But I do think that the window of opportunity to just be buying cheap per square foot, good quality buildings that are leased to good tenants that have a lot of reversionary potential and deploy a lot of capital very quickly, almost in like a core plus value add type fashion, I think that's probably a year or two.
We haven't even spoken about Deutsche Bank's former HQ.
No, we haven't.
Round 2. Well, look,
round two.
We'll save that for
when we lease it. You can have me back.
So, Michael, you've phenomenal background, story, experience. come over for 2 years, stay here for 20, build a business, and go on a hell of a journey through multiple different cycles with a lot of headwinds as well in terms of the last 15 years. So thank you so much for being so open, honest, candid, and sharing a little bit about your story. And I'm really excited to see what you and the team are going to do.
Great.
Moving forward.
Great. And I'll see you next time.
Hey, quick one from me. If you enjoyed this conversation, do me a favor and share it with a friend or colleague that you think would get value from this conversation. It would mean the world and help grow the People Property Place podcast. Thank you so much.